Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Julian Emanuel starts us strong this morning. Single best paragraph I've seen on innovation, bull markets, and drawdown. Quote, don't fear a bull market drawdown. It's normal. It's not a correction even. It's sort of like NVIDIA was down 4 days in a row. How do you respond to that as an investor not as sophisticated as Julian Emanuel?
You have to think long term. And again, you hit it a few moments ago. People up in the snack court getting teary-eyed because they're sending their kids back to school. September never fails to disappoint the bulls. There's always a time, and it started that way yesterday. And from our point of view, none of the elements that end bull markets are present. And so, even if you look back at all the great bubbles, 1999, for instance, you had 4 discrete 10% plus drawdowns in a 9-month period where the NASDAQ rose over 100%.
So what are we doing here? Are we sticking with the big tech names, Julian, or are we trying to find some value outside of what has worked so well for so long? So
our view into 2026 is that big tech will continue to lead. This is an AI-driven bull market, okay? But again, stomaching that volatility isn't necessarily for everyone. And frankly, what we're trying to do is sort of isolate the people that would prefer to have an element of hedging in their portfolio, because quite honestly, if you sort of transfer a little bit of risk, it enables you to buy the dip that's inevitable. So for us, that's low evaluation stocks and a little bit of a defensive tilt.
Okay, you go into La Tête d'Or downtown, the steakhouse, Daniel Boulud's steakhouse, and the place falls quiet when Julian Emanuel walks in, because you write the single best earnings summary every day of the earnings season. Nobody's talking about quarter ending September 30. How do you and Ed Hyman frame out revenue growth off nominal GDP and the earnings season that begins October 14th?
Well, it isn't going to be as strong as these last couple because it's just not.
Yeah, but you said that last time and you got it wrong.
And well, no. Actually, the person that concocts our surprise indices actually got it right. Hats off to my colleague Stan Shipley for that. But frankly, what it says in general is there's more to all of this than just the bump from inflation. There is organic growth going on across business. And frankly, you're seeing it, really broad-based, given the fact that what's different about this bull market as opposed to the internet in the 1990s, is you're seeing the vast majority of stocks advancing together. Tech is outperforming, but you're seeing them advance together.
What do you think we're going to get from this Federal Reserve? What does the market need from the Fed? Does the market need a big easing kind of play over the next 12 months or not?
The market expects easing. Certainly the political will seems to be pointing towards more easing rather than less. I would say that if you look at the last couple of years, provided that the direction of travel in terms of the economy is an expected trough in growth in the fourth quarter, and then you get gradually higher growth. We don't necessarily need that degree of easing, but we certainly do require a cut in September.
How do you respond to the idea that retail has a wall of money? They have pension money. Eric Balchunas says it's all going into ETFs, almost as an immovable force, like an aircraft carrier going through the water. How does that change guessing the market?
Well, Jack Bogle had been talking about this for 20, 30 years previously. And what it actually does at the margin, because there's so much money going into ETFs is that it gives you more of an opportunity to isolate the winners and the losers because there are mispricings at the individual stock level. And we've seen that throughout this bull market because correlations among stocks are at some of the lowest levels they've been in a generation.
When you go talk to your institutional investor clients, Julian, around the world, what do they want to talk about? What's the question they really hit you with the most?
It's certainly all surrounding AI.
Really?
You know, yeah, surprise. And then the other surprise is valuations. Look, it's an uncomfortable time if you're sensitive to valuations, and generally we are. But this is an environment that all the fundamental underlying trends support, persistent higher valuation.
One final question. Wei Li from BlackRock says she's going to leave if you don't answer this. Where's Ed Hyman on the American economy right now?
We're troughing and I go back to April when the entire world thought we were going to have a recession.
Wei Li didn't. She was long.
Well, Evercore ISI certainly did not. And we don't see it either. And we also see inflation peaking in the fourth quarter and gently falling over 2026.
Valuable. Julian Emanuel, thank you so much for getting us started. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Julian Emanuel, the Wei Li Global Chief Investment Strategist at BlackRock. Well, Wei Li, we can do like a 2-hour conversation here, but let me just dovetail it over to the bond angst. To me, it still reads idiosyncratic. Story by story versus a large global bond sell-off. Do I have that right?
There is a fundamental theme underpinning this bond yield repricing. And this is to do with term premium needing to reprice to reflect the steeper fiscal trajectory and the broadly still persistent inflationary pressure. Now, there is a country-specific flavor to the individual country bond market, but for the reasons that I just laid out, we have long held the view that long-dated bond yields needs to reprice higher. But they never reprice gradually. Right. They always reprice suddenly, which is why we are where we are right now.
Well, it's very suddenly. Wei Li, what does it mean when out past 10 years we reprice? What does it mean for the shorter term paper that most of our listeners and viewers are in?
So, Tom, as you know, we have had the view of the curve needing to steepen. So in part, there is a underweight to the long end of the curve, but there is also a preference, a implicit overweight to the front end of the curve. And so far this year, we have seen significant steepening, but more relative to the very long end. So I'm talking about 30-year rather than 10-year. But what has also happened is that the front end of the curve actually priced in more rate cuts, especially kind of going out to the end of next year. So that is further supporting this steepening view, meaning that it actually played out better than we expected. We were expecting to just collect coupon from the front end of the curve, and we're also getting capital appreciation because of the rate path repricing. So that's done really well and almost too well. We still have the steepening view, but because of the very significant steepening that we have already seen relative, especially kind of all the way out to 30 years, I think that view is a lower conviction at this point.
Wei, we saw early this year when there's all the concern about some of the tariff policies, a shift in asset allocation outside of the U.S. to the rest of the world, including European equities and so on. How do you see that these days? How do you think about geographic allocation of capital?
I would say from a tariff consideration alone, that does not immediately translate to international markets over the U.S. market because it has global read across, and international market have also come under pressure because of tariff read through. If you think about kind of the dynamics of negotiations, it does not automatically mean that tariffs, because it's mostly uncertainty coming from the U.S. It needs to be negative for U.S. and more positive for international market. What's happened so far this year in terms of the outperformance of international markets, specifically Europe and maybe parts of emerging market relative to the U.S., has everything to do with a weaker dollar. Now, a weaker dollar, now close to 10% down on the year, has everything to do with, number one, cash path has repriced lower, and number two, term premium has repriced higher. And the combination of both of those things would lead to a weaker dollar, which we have had, and that has meant international markets are looking on a relative basis better. But the bigger fundamental picture remains when we look at earnings. It's still mostly U.S. markets that are driving meaningful earnings growth, and within U.S. is still around the ecosystem of technology, AI, tech plus. International markets are really struggling to grow earnings. Maybe emerging markets are doing better, but there's a translation effect.
Wei Li, one final question. The United Kingdom is an ungodly mess. We're going to be covering this. Marcus Ashworth, folks, out with a brilliant essay today. We hope to get him on tomorrow. Wei Li, how does that work out? I mean, with Liz Truss, it was a true crisis. Are we like a Liz Truss moment, or is this different with the Chancellor of the Exchequer?
Well, UK seems specific, but the challenge that they face is not specific to the UK. UK is perhaps more emblematic and more pronounced, but the bigger picture is that this is a tougher trade-off environment facing the government and facing central banks. The government is facing a tougher trade-off between fiscal discipline and also the need to spend more to boost growth. And the central bank is facing a tougher trade-off between supporting growth and managing price stability and inflation. So in this world shaped by supply constraint because of mega forces, we've talked a lot about them, a tougher trade-off is really characterizing the UK in particular, but across the major economies.
Right. Too short a visit. Wei Li, would love to get you in the studio here when you can again. Wei Li is with BlackRock. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joanna Chua with us with Citigroup, head of emerging market economics, chief Asia economist with a huge platform for the International Bank. You're at the University of Philippines. You fly into Logan. Good morning. Your first day at Harvard. What was it like your first day at Harvard in their PhD program?
Well, this is back in the mid-90s. Completely intimidated. But hey, I'm a product of globalization. I mean, here's someone who came into Philippines, had nothing, and it was a great experience.
Who was your advisors at Harvard?
So Marty Feldstein.
You had the privilege of Martin
yes,
Feldstein.
Absolutely. And David Cutler and other fantastic professors.
Okay, that's a good way to migrate to the fiscal debate. You got a little bit of that with Marty Feldstein. Professor Feldstein was a huge supporter of what I've done for years. How messed up is it, or is it idiosyncratic right now, where the Philippines say we'll do well and Japan's keeling over?
No, it's really interesting, the divergence we're seeing between emerging markets and developed economies. And I guess that's probably symptomatic of the fact that so many emerging market countries have gone through repeated bouts of crisis in the past. So in a way, they've learned to they've been disciplined by the market to keep their fiscal house in order.
See it in the Bloomberg indexes.
Yes, but you look at US, exorbitant privilege. So if you've gotten away with a lot of things, it takes a lot politically, it becomes very difficult to actually self-correct. So it is interesting to see some of these divergences happening. But of course, we are still getting in. I mean, a lot of the sell-off we're seeing in developed markets obviously seem to impact a lot more what's happening in DM markets for a lot of idiosyncratic reasons. And then we'll see to what extent parts of emerging markets can be relatively more insulated.
You're based in Hong Kong.
Yes.
You're coming here to New York. You're meeting institutional investor clients. What's your message today about Asia?
Look, I think the message is we are slowing down. I mean, we've had a lot of positive surprises in second quarter GDP growth, but I think there's really a risk going into second half with the reversal of the export payback effects, because a lot of these tariffs kind of kicked in belatedly. And then all this uncertainty is going to have an impact on CapEx. And CapEx is a very trade-intensive activity. So overall, I mean, Asia hasn't really had much inflation. I mean, even before all of this, we've had very benign core inflationary pressures. And so I really think there's not a lot of hurdles for central banks to continue to be relatively, dovish and benign. And that's kind of the macro theme is really more of a slowdown theme. But having said that, despite the slowdown, we can still have some kind of disconnect between macro fundamentals and financial markets. Look what's happening to Chinese equities.
So how are the tariffs playing out across Asia writ large?
No, so it's really kind of interesting because at the start of the year, Trump campaigned 60% tariff on China and 10% on everyone else. And there was a lot of hope that there would be a CapEx supply chain move to other parts of Asia like ASEAN. But if anything, what's happened is China's net export engine has actually been stronger than expected. And the tariff differential is narrower than expected. And then when you factor in this transshipment levy, it even complicates things. So in a way, this rebalancing is kind of not really happening. And so I think, obviously, it's still a challenge. I do think we're not seeing it fully in the data because of this front loading, but we are starting to see parts of Southeast Asia really see a slowdown in exports like Thailand, Malaysia, Singapore. And I think this kind of excess deflationary pressure, excess supply out of China impacting manufactured goods is a challenge.
So overlay a dollar call here. I don't want you to do FX strategy for Citigroup, but to me, the heart of the matter is the release valve of the system in a given structured trilemma is currency movement. How does the steam out of the pressure cooker in the dollar work out in the 18 months forward?
Okay, well, our view is that at least in the next, until by the end of the year, we are still expecting dollar weakness. And part of that is really on the view that we're expecting the Fed to cut, and we're expecting the Fed to cut every meeting for the next 5 meetings. So as U.S. economy is expected to slow down, I mean, we had this upward revision in second quarter, but inevitably it's going to slow down. It's going to slow down faster than some of the
Philippine peso strength, that's Sing dollar strength. That's even yen strength. I mean, I don't want you to make a call on yen, but a 148 down to a 140. Can they withstand now those strong currencies given the Trump tariff regime?
Well, in the case of Japan, I mean, the currency, despite any movement, I mean, it's still relatively on a real effective exchange rate quite cheap in Japan.
Right.
For the rest of Asia, I mean, this is why I kind of started off talking about central banks having more room to cut, because if in the end your economy is slowing down and, dollar is not really a hurdle, if anything, when you have an export slowdown, rather than have the FX weaken as an automatic stabilizer, it's kind of going against you. It gives you a little bit more room to kind of ease monetary policy. The other interesting thing that's happening is kind of dollar CNH, dollar CNY fixings being relatively strong and stable. So again, I mean, it's going to be interesting whether going into 15th five-year plan, if there's more messaging from China of rebalancing, to what extent does that get reflected with a greater acceptance of a bit of stronger renminbi?
So how does China view the U.S. as an economic partner, competitor? What's China thinking these days?
I mean, obviously, trust trust is something, once you lose that, it takes a long time. Look, I think China is going to be very, very careful. They now realize the lesson that, hey, it pays to have economic leverage, to have a choke point. So having that choke point of critical minerals really helped them to de-escalate the tariff, which is why I don't think they want to give up that choke point. It's very important to have leverage. And again, of course, they still need to deal with China, the U.S. It's still a very, very important economic relationship. So I think they're going to want to, obviously kind of stay engaged to a certain extent and have some positive overtures if there is a Xi-Trump summit by APEC in November. But, I mean, China is still going to be diversifying its economic relationship.
When you were at Harvard, did Ken Rogoff throw a piece of chalk at you?
He wasn't at Harvard when I was there.
He wasn't there. Yeah, Lucky for you. Here's my book of the summer, Our Dollar, Your Problem. Folks, I'll do all the books out, try to get it out today as we begin the autumnal season here. Our Dollar, Your Problems is a wonderful compendium of fiscal financial crisis. Do you have in the back of your mind, given Trump tensions, France tensions, Italy, whatever, that where we could get to a point of volatility here?
Look, I think it's really interesting. I mean, look, I think there are some debates about how much of dollar weakness is structural versus cyclical because U.S. is going to slow down. Look, I think I don't want to over-exaggerate the structural de-dollarization story because the reality is there's not really a lot of alternatives. But I do think something is happening in terms of markets wanting to have a higher term premium for long-dated U.S. Treasuries because of fiscal risk, inflation risk, kind of mercantilist policy wanting a weaker dollar, and any risk of economic coercion. So I think there's something there that it's happening at the margin. But I mean, dollar is still very dominant.
One final question. We have a display, back to my ute, of a Chinese military might in the last 24 hours. North Korea, Russia, China all lined up. Lots of holding hands with India and that. What does it symbolize for your bank about the Pacific Rim and over to South Asia?
No, look, I think there is really a tug of war going on globally now about the kind of the levers of economic power. And I think, there is a lot of changes. I mean, a lot of people are talking about changes in world order and to what extent are we moving towards multipolarity, and is this going to be an orderly adjustment or not? And I think what we're seeing here is really a sign of kind of a posturing that's coming out of, obviously China and kind of showing that they're...
Okay, I need to get you in trouble with compliance. I'm running out of...
Absolutely.
I got to get you in trouble with your lawyers. Do you look at the Trump regime as a one-off, which we will heal from, or is this a seismic shift in global economics?
Well, again, I am from, I'm hardly, you probably know more about U.S. politics than I do. So again, I think hopefully this is part of an adjustment and pendulum swing, and they maybe pivot a little bit. But look, I think he got elected twice. So it's hard to ignore the fact that there is something underpinning kind of this populist movement going on in the U.S.
While you're at it, bring the M-bar back at the old Mandarin in Hong Kong. We'd like to see that. They took it away. It had a brass plaque at one of the seats. Joanna, thank you so much. Joanna Chua with us with Citigroup. Just wonderful there. They're Asian economists. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Time for your September civics lesson, only with Professor Cantrell of PIMCO. Pocket rescission.
Oh, yes.
Murkowski of Alaska's mental about it. Mike Rounds, pheasant hunter from South Dakota, mental about it. Inform us. What in God's name is a Trumpian pocket rescission?
Basically, this is an effort by the White House to cut spending that Congress has already approved. And this is a real poke in the eye to the institution of Congress. I think there have been several of those by actually both President Trump and President Biden, and just I think the executive branch in general over the last few decades, as the executive branch has become more powerful and Congress has become less powerful. But the pocket rescission, I think, is definitely exacerbating already tensions on Capitol Hill. I don't think they'll allow for it. I don't think this will actually happen. But just the fact that we're talking about it and that members of Congress are very upset about it, I think will cause even more frictions.
We get in New York when they go out, they go back home. It's recess. A lot of people are getting yelled at in meetings. Mm-hmm. What's the internal body language of representatives and senators after going home and listening to the voters?
Well, I think the Republicans in Congress, in both the House and the Senate, took a very bold vote by voting for the One Big Beautiful Bill. Of course, that the extension of the Trump tax cuts, additional new tax cuts, but also some Medicaid cuts. And they are hearing from those folks who are really upset about those cuts. I think they are trying to sell this as a pro-growth, sort of pro-middle class bill. I think remains to be seen. If you look at polling, I think that folks are sort of skeptical of that narrative. I think the big question, though, will be in the beginning of 2026 when some of these tax cuts will come to fruition. Will that sort of the sentiment around this change? But it's been difficult. I mean, this was a big legislative feat, honestly, for Speaker Johnson to pass this with such a small majority, but not sure, well, sort of TBD on whether the electorate is how well it will be received.
Is our government going to shut down at the end of September?
Well, I think that's a big question. And actually, this pocket rescissions sort of makes it, I think, even more, maybe more relevant. Of course, the government has to be funded every fiscal year. That fiscal year begins October 1st. Unlike lots of different types of bills, for government funding, that requires 60 votes in the Senate. That means that, by definition, Republicans need Democratic cooperation. So you need, by definition, a bipartisan bill to avoid a government shutdown because of these things like pocket rescissions, because of friction between Republicans and Democrats right now. I do think there is a pretty high chance that we could see at least a temporary government shutdown, or at least a lot of drama around it.
Let's go micro here with French Hill. I mean, we know French Hill quite well. Financial Services Committee, Arkansas. I'm going to say he's putting up with the Trump Act as being a different kind of Republican. People like French Hill and the GOP. What's the backstory right now? Are they just trying to get to March, where again it's the election frenzy of November?
Well, look, I mean, I think a lot of Republicans in Congress, I mean, I don't know about Chairman Hill, whether he feels this way or not, but presumably he does, is that they have their majority much thanks to President Trump. So, I think that what we see in every cycle, every new administration, the party in power gives their president a lot of wiggle room, a pretty wide berth in terms of doing whatever they want to do. I do think, though, to your point, that kind of window, that flexibility starts to close as we get closer to the midterm election. And
give me a month. Don't give me a week or a day. Give me a month. Come on.
Oh, my goodness. I think that next year, as we go closer in fundraising, what have you, I mean, Republicans have done a great job of fundraising. I mean, really, the Democrats are much more in the wilderness, if you will, than Republicans, particularly in fundraising. If fundraising continues to be healthy, the president may be able to keep his party, together. But usually, what you see is going into a midterm election cycle. Usually, the spring, Tom, to give you sort of a time frame, is usually when folks start walking away from there.
That's when the Denver Broncos rebuild for the next year.
Okay, you know what? We're not going to have to rebuild, Tom. We are looking quite strong. Thank you very much.
Thank you. So, Libby, I mean, is it too early to start thinking about the midterm elections here? I
mean, I think it's, we'll see in terms of, the sentiment. I mean, September of the year before the midterms usually is pretty early. We'll have some elections that are happening in November. The Virginia gubernatorial race, New Jersey has, So these are, these can be kind of canary in the coal mine, if you will. I think it's important not to extrapolate too much from those sort of off-cycle elections. Broadly speaking, though, if past is prologue, Republicans will probably lose some seats in the House. They, of course, only have a 2-seat majority right now. That's why you're seeing them really focus on this redistricting effort, which is quite unconventional. Usually redistricting happens every 10 years after the census. They're accelerating that, and with the hopes that they can actually add some new Republican safe seats and potentially defy history and keep the House.
Get one more in here, Paul.
I ask a lot of the Washington folks, where's the Democratic Party today? I don't hear them. I don't see them. I don't know who do I.
It's amazing. It's amazing.
Talk about rebuilding.
They're
having a rebuilding year or rebuilding years. I mean, look, their brand is incredibly tarnished. I mean, if you look at polling for what it's worth on both Republican and Democratic side, but the polling suggests that they have the lowest favorability rating that they've had for decades.
Okay, but in 1962, Nixon, he loses the California governor's race. He's at the absolute bottom. In 6 years later, he was president of the United States. Where is that initiative on the part of the Democratic Party?
Well, I think a lot of folks who are going to be the future leaders of the Democratic Party are trying to sort of, again, maybe give the Democrats in the House and the Senate a wide berth, if you will. I think what you'll really start seeing after the midterm elections is folks are appearing, kind of sticking their heads out of the sand and maybe start leading the Democratic Party. But until then, I think it's going to be what we're seeing, which is just incoherent may be too strong of a word, but it is pretty incoherent.
I'm shocked that some young Turk, male or female, hasn't just stepped up and says, I'm going to be the face. We haven't seen that.
I mean, we do have a New York City mayor race that I think some folks.
Is Washington watching the race? We saw Mayor de Blasio endorse Mr. Mamdani.
I think Republicans are chomping at the bit. I think they would love to have a New York City mayor, Mamdani, because then they can, demagogue him. And even though, of course, as we all know, New York City politics is quite different than national politics.
It's a weekly visit with Libby Cantrell. I like this.
I love it.
Put it on the calendar. She's with PIMCO, folks. A great student of what our elected officials are doing.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.